Okay, we'll get started. Hello, everyone. On behalf of Marie Bruyère and Sophia Ramos, it's a pleasure to welcome you again to this webinar organized by the ESSEC-Amundi chair. I would also like to thank Vanessa Thomas for the logistics. Today's webinar focuses on the use of text-based methods in finance. The last 2 decades have seen a rising use of new information from text sources to get a better understanding of financial markets. Recent developments in AI and machine learning technology provide new possibilities to go deeper into textual data and extract information which may not be captured by standard numerical data. New language models are also able to better understand complex relationships with the text and potentially improve our ability to better understand and predict. The 2 papers in today's program provide a new light on the use of text analysis. In the first paper, presented by Tingyu from the University of Zurich, the authors develop a new text-based green innovation measures at the firm level to quantify how financial markets integrate green innovations. The second paper, presented by Dacheng from Booth School of Business at the University of Chicago, aims at better exploiting text data sources by constructing refined use text representation derived from large language models and then using them to improve model expected stock return. As usual, participants are encouraged to ask questions on the chat. They will be answered at the end of each presentation. I wish you a very good webinar. And now let me turn to Marie Bruyère, Head of Investor Intelligence and Academic Partnerships at the Amundi Investment Institute. Marie?
Thank you very much, Jocelyn. So in the name of Amundi, it's my great pleasure to welcome you together with Jocelyn Martel and Sophia Ramos on this webinar on the use of large language models in asset management. So in the asset management industry, we are using more and more alternative data, and in particular textual data, to analyze, for example, regulatory filings, corporate communication, such as earnings calls, news, social media information. But the recent advances of large language models now allow to process this information much more efficiently, quicker, also than traditional NLP techniques, such as bag of words. And their added value, for example, in deciphering text news, is well demonstrated by the paper by Dacheng. This is particularly valuable in the ESG space, where we lack data. And Tingyu's use paper is a great example of such a use case, measuring companies' green innovation activities, which are really essential to the green transition. But there is also a lot of debate, and in particular among regulators, on the consequences of using large language models in the industry in terms of explainability, reproducibility and reliability of the results, fairness, risk of manipulation. So I think it is essential to understand better their main value added, but also their pitfalls. And I'm sure the 2 papers presented today will be very helpful in that. So I'm very delighted to welcome our 2 prominent speakers, Tingyu from the University of Zurich and Dacheng from the University of Chicago. We are very honored. So I would like to thank you for your participation. And of course, also Sophia, Jocelyn, and Vanessa for a great partnership between ESSEC and the Amundi Investment Institute. And also thank our colleagues, partners, clients who attend the conference. So I hope you will find this useful.
Thank you very much, Marie. So the first presentation by Tingyu from University of Zurich.
Thank you very much for the introduction. And now we'll try to share my screen. Can you see my slide?
Perfect.
Yeah, very nice. Hello, everyone. My name is Tingyu. I'm a postdoc from the University of Zurich. Thank you so much for inviting us to present our paper, Our Green Innovation Priced Evidence Beyond Pattern, in this great webinar. So this is a joint work with Marcus Leopold. So as we all know, the global community are striving for a net zero emission target. During this process, green innovation plays a crucial role in both mitigating climate change and adapting to its adverse consequences. For example, the technology related to renewable energy and electrifications can help companies reduce their emission and sustainability to transition risk. On the other hand, adaptability adaptation-related technology can help companies equip with the resilience against the physical risk. The important role of green technology is also supported by the 2022 annual letter from Narrow Fink, the CEO of BlackRock. He believes that the decarbonizing of the global economy is going to create the greatest investment opportunity of our lifetime, and the next 1,000 unicorns will be the sustainable innovators that helps the world decarbonize and make the energy transition affordable for all consumers. Despite its importance, our understanding of the pricing effect of green innovation in the stock market remains insufficiently explored. So in this paper, we try to bridge this research gap by examining the empirical relationship between green innovation and the cross-section stock returns. The literature shows that green firms are lower expected returns compared to browner ones. But many of them focus on the problem side of the climate equation and use measures that capture brown activity of companies, such as carbon emissions and industry pollutions, which depict firms' past environment performance. In contrast, in this paper, we focus on green innovation, which provide a forward-looking perspective from the solution side. Importantly, even for companies that currently have considerable carbon emissions, if they engage enough in green innovation, they are better prepared for the future that with more stringent environmental regulation, as they are more effectively reduce their carbon emission with the related technologies. Understanding the market perception of green innovation is crucial, as it can guide policymakers in designing incentives and regulations to promote green technology. One commonly used measure in the literature is a green patent. This measure provides a tangible assessment of firms' inventive efforts, but it also contains some inherent limitations. The first one, and also the most important one, is that green patents often ignore non-patentable innovative strategies that can also notably improve companies' environmental performance. This is especially relevant for green technology, in which the adopter and inventor of technologies often diverge, while the adopter tend to be carbon major emitters that are more responsible to reduce their carbon emission by deploying external green technologies in new contexts or at a large scale. Such kind of process also require innovative sourcing and critical thinking, but it is not captured by patent records. Green patents also tend to uniformly treat the technologies with different mitigation importance, and some of the patents never reach the market. The lengthy application process, which often takes years, tend to reflect outdated information. To sum up, we need a new measure that can more comprehensively capture firm-level green innovation engagement at real time. And that is what we do in this paper. And we have two main contributions. First, we provide a text-based firm-level green innovation measure by using foundation models like ClimateBird and GPT-3 models to analyze two types of text. The first one is a green patent abstract, and another one is earnings call transcript. We quantify the firm-level green innovation measure as a percentage of sentences related to green innovation within each earnings call. So the basic idea is that if the company discusses more green innovation, then we assume they engage more in green technology. This measure elevates some restriction on patent data. First, it provides a more comprehensive view, including non-patentable activities. As managers tend to discuss such kind of activities if it sufficiently impacts their corporate strategy and environment performance. And this is captured in the texture information so that we can collect it in our measure. The time limitation of earnings call need the managers focus on the most critical actions and less likely talk about those strategies that do not directly impact firms' sustainable practices. The quarterly occurrence of earnings call also ensure timely updates and allow us to capture the time evolution of corporate priority. Combined with the green pattern data, our textual measure allow us to categorize firms into green patterning and non-patterning groups. Specifically, what we do is we collect firms that discuss green innovation in their earnings conference calls, and we split it into two groups, depends on whether they have at least one green patent during the sample period. So if they have green patent, then they will go to the green patented group, and such kind of green innovation discussion in their earnings conference calls tend to capture how the firm develop and adopt their in-house claimed innovation. If the firm do not have any green patent, then they will go to the non-patented group, and their green innovation discussion tend to reflect the adoption of external green technologies or the implementation of novel but non-patentable sustainable strategies. We try to conduct the empirical analysis on both the two groups and explore whether the empirical implication is different for the non-patented group in terms of their innovative engagement. Our second contribution is to study how green innovation is priced in the cross-section of stock returns. And we observe that green innovative firms exhibit lower expected returns over the whole sample period. We explain it as these firms are less risky because they better prepared to the transition to a low carbon economy. And we get two sets of evidence to support this view. On the one hand, these green innovative firms have better environmental performance in the future as they reduce their carbon emission levels and have fewer negative climate incidents in subsequent years. On the other hand, we observe these green innovative firms better hedge against the transition risk according to event study. And we conduct event study on 4 events in United States that imply changes in environmental regulations. These innovative firms experience value increase during the enforcement of stringent climate regulations and the recent increase in green innovation attention. More importantly, we found all these empirical results, including the negative return effect, the better environment performance, and the better hedging ability, extend to green non-patented firms. Therefore, we take the perspective in this paper that the value of green innovation do not only lies in its invention, but also the adoption and application within corporate strategies, which we captured in the textual measure. One concern of our measure arises from the voluntary disclosure nature of earnings conference calls. This is because sometimes the managers may do window dressing or reiterately mention some stale activities. To alleviate this concern, we first the environment improvement of non-patented firms provided the direct evidence. But we also conduct a robustness check on textual measures that are only constructed from the question and answer session, which is more engaged, more interacted by investors and analysts, so less controlled by the managers and less prepared by them. So we assume this part will be less impacted by greenwashing issue. And we also focus on the forward-looking statement within the green innovation discussions. Both give similar results, so partially address the concern arise from the voluntary disclosure nature and the textual analysis. So our paper contributed to several streams of literature. First, we build on the papers study the financial performance of green patent. Some papers shows that examine the impact of green patent numbers on the stock abnormal returns after announcement date. They observe that stock market do not react to green patent, but only non-green patent. While Hedge et al. 2023 shows that firms with more NACI claimed patents earn higher cumulative abnormal returns. Different with this paper, we do not look at cumulative abnormal return, but instead we use the future realized return as a proxy for expected return and observe a negative return pattern for green innovation discussions. Second, we added to the literature that explores the effect of green patent on environmental performance. Bolton et al. 2023 shows that firms with more green patent do not decrease their future emissions, while we uncover a carbon reduction effect for companies discuss green innovation in their earnings conference calls. This may suggest the importance of a broader scope of green innovation activities to better comprehend the role of green technology in addressing climate change. We also related to the research that show patents do not fully capture corporate innovation, as well as research that measure firm-level climate change exposure using texture analysis. We supplement this literature by focusing on green innovation and utilizing cutting-edge natural language processing models. Then I would like to go to the details of our paper and introduce how we construct our measure, the determinants and the negative pricing effect of green innovation, as well as the comparison among the two groups. So let's start with the data we utilized. So our texture measure rely on two types of text data. The first one is the patent abstract extracted from the United States Patent and Trademark Office. It also provides additional information about patents granted in the US, such as the publication number, the grant dates, and the CPC and IPC classification code, which can be used to detect whether the patent related to climate change or not. We adopted the strategy of OECD and Nance et al. 2011 to categorize the green patent into 6 different types, including energy use, production, transportation, adaptation, building, and environmental management. Our baseline firm-level green innovation measure rely on the earnings call transcript from Refinitiv. So in each earnings conference call, managers will give a presentation about the firm's performance in the past quarter, and analysts and investors can deeply interact by asking questions. This provides us with an ideal situation to understand the market perception of a firm's green technology involvement. We utilize the stock return data from CRIS and the accounting data from CompuState, and the sample period is from 2008 to 2021. Our natural language processing procedure consists of 3 sequential classification tasks. So for each sentence in earnings conference calls, we will first detect whether the sentence is transition related or not. If so, whether it is related to green innovation and which type of green innovation it belongs to. These classification tasks are conducted by Clambed-Bird model, which is pre-trained on extensive general and claimed text and provide state-of-art performance on claimed-related downstream tasks. In order for the Clambed-Bird to gain the skill to differentiate whether the sentence is green innovation related or not, we needed to feed in training sentences related to green innovation so that the BERT model can learn from the sentence structure and know how to do the classification for new sentences. To prepare the training sentences related to green innovation, we leverage information from green patent abstract. However, patent abstract tend to be non and highly technical, which is cannot be easily understood by investors or discussed in earnings calls. Therefore, we ask GPT-3 to summarize each of the green patent abstracts into a single sentence that can be easily understood by investors. In such case, the sentence do not only contain information about green technology, but also in a way that is highly likely to be discussed in the earnings conference calls. So we use these green innovation related sentences as positive sample, combined with some other general sentence as negative sample, and fine-tune our climate bird model, and then apply on the entire earnings call transcripts. We quantify our green innovation measure as the number of sentences related to green innovation scaled by the number of all sentences within each transcript. So more discussion, more engagement. One example could be clear. So in this table, we show one patent in transportation from a company called Baidu. According to the title and abstract of the patent, there are several professional terms and also very non and not easily be understood by investors. In contrast, the GPT-3 summarization version is much shorter and also, more importantly, it contains the information related to climate change from the patent, which is a driverless vehicle to help reduce power consumption. So in this way, we similarly generate several training sentences with green innovation. We independently apply this fine-tuned climate bird model on each earnings calls, irrespective of whether the company have green patent or not. And for this company, we exactly found one sentence in their earnings conference call with the same topic, and mention the autonomous driving that can bring incredible operating efficiency and reduce carbon emission. There is also possibility that the company do not have any green patent, but they discuss green innovation in their earnings conference calls. So here is another example. We detect adaptation-related innovation related to groundwater reliability improvement project in the discussion of this company's earnings call. In short, there are two key differences between our textual measure and the green patent. The first one is that we tend to capture broader information, as firms without the green patent can also discuss their related activities that are unfeasible to patent, and we capture by using textual analysis. On the other hand, even for the company with green patent, we could provide a more precise assessment as the limited length of earnings call only allows for discussion of important green innovation engagement in real time. And we will provide more comparison among the two measures in the last part of the presentation. So let's briefly talk about the determinants of the measure. And we first link it to the green patent. We consider the number of green patent, the share of green patent, the economic value weighted and citation weighted green patent shares. When controlling for industry fixed effect, all of these exhibit a positive and a significant association. Therefore, compared with industry, firms with more green patent are more inclined to discuss green innovation in their earnings call. On the other hand, we use the green innovation discussing proportion in the past year as our dependent variable, and use the green patent as a dependent variable. We control for the firm fixed effect. So the explanation would be compared within firm, those with increased related discussion tend to have green patent with higher economic values and citations in the future. This also partially address the concern that our textual measure only capture greenwashing. Then we explore the role of carbon emission and climate policies. Panel C shows that many green innovators are carbon intensive, and we conduct a difference in difference regression on California crop and tree system. So for companies located in California, they tend to discuss more green innovation in their earnings call after the enacting of the policies. However, this effect primarily exists among large and financially unconstrained companies. Now let's go to the main part of the empirical analysis to explore whether green innovations are priced in the stock market. We start with the univariate portfolio sorting, and so at the end of year T-1, we sort firms into 5 portfolios based on their discussion proportions. The no portfolio contains firms with the least but positive green innovation proportions, while the high portfolio contains those with the top proportion. We link the measure with returns from July of year T to June of year T+1. The 6 months delay allows the information to be available for investors and avoid the look-ahead bias. So we hold the portfolio for 12 months, and the sample period is from 2008 to 2019. We can observe that the evaluated portfolio returns decreased from 1% in no portfolio to 0.6% in high portfolio. This results in a 0.41% return spread for the high minus no portfolio. We also consider the equal-weighted portfolio returns as well as the return spread between high portfolio and zero portfolio. Both give consistent result. So the green innovation negatively predict the future returns. Then we conduct the asset pricing factor test and perform time series regression of the portfolio returns on different common risk factors. So we consider the pharma fringe 3 factor and the momentum factors in panel B, and pharma fringe 5 factors in panel C, and Hou-Xue Zhang-Q factors in panel D. All the risk-adjusted returns persist in magnitude and significance. So the common risk factors cannot explain the return spread we detect. We then conduct the pharma-McBurn's cross-section regression with industry fixed effect. This allows us to consider several different independent variables at one time. Column 4 and 5 explore the effect for different types of green innovation, and we found that the pricing effect mainly stays from the energy-related innovation. For robustness check, we consider a series of transition-related measures, including the carbon emissions, ESG scores, and alternative text-based measures for climate change from Santana et al. 2023, and another text-based innovation data, which apply LDA on analyst report for S&P 500 firms. This robustness check show a consistently negative effect, suggesting that the return effect is not driven by other climate exposure and general innovation. However, most of our results exist before 2020. So in this figure, we plot the cumulative abnormal returns of the high minus no portfolio in the blue line. So before 2020, the return effect is continuously negative. However, there is a return reverse in recent 2 years, and the green innovating firms outperform their less innovative peers. Inspired from Pastor et al. 2022, we believe this is not because the change in expected return, but because we utilize the realized return to proxy expected return. And there is a sharp increase in demand for these green innovative stocks due to increased attention to green innovation. Therefore, we also plot the monthly green innovation attention index in the red line, which also rely on based on our textual measure. So in each year, we calculate the average innovation discussion proportion across firms, and then we compute the 3 months moving average to reduce the volatility. In this monthly index, there is a sharp increase in recent 2 years, which is perfectly aligned with the outperformance of green innovative firms. To more directly test this result, we construct an unexpected attention measure by using the AR1 residual of green innovation and add it as additional control in our asset pricing factor test. So the left figure shows the result for the cumulative returns for high minus no portfolio. It is positive with a large magnitude. After we consider the pharma French 5 factor with momentum factors, the magnitude becomes smaller, but also positive. If we further control the unexpected attention, this result becomes negative. And if we look at the entire sample period, the contrasting effect vanishes after accounting for unexpected attention. So the return reverse arises from the in-sample shock and our utilization of realized return. So for robustness check, we use alternative proxies for expected returns rather than realized return, including the option-based expected return obtained from Martin and Wagner 2019, as well as the GOS-based implied cost of capital. So both measures exhibit a negative and significant coefficient, even if we consider the recent 2 years. So companies with more green innovation discussions have lower expected returns. But how can we explain this result? We believe this is because they can better hedge against transition risk. So we first look at their environment performance, and we found that we regress the scope 1 carbon emission on the previous green innovation discussion proportions and observe a carbon reduction effect, especially for those invest in energy, building and environmental related technologies. On the other hand, these firms also have smaller number of negative climate incidents in the future year, particularly if they involve in production and adaptation technology. On the other hand, we conduct event study on 4 climate events in the United States that imply changes in environmental regulation. So we first have a look at the Trump's election. As we all know, Trump do not really believe in climate change. So after its election victory, it implies more relaxed environmental regulation in the United States. And we correspondingly observe the underperformance of green innovating firms as the green economy they would have benefited from now become more uncertain. We also look at other 3 events, including the Biden's election, the Russia-Ukraine war, and the Inflation Reduction Act, which imply a more stringent climate regulation, and these firms outperform. Therefore, green innovative firms exhibit greater resilience and adaptability when facing potentially stringent environmental policies. And we can see they can better hedge against this transition, which can potentially explain their lower expected returns. Finally, we compare the green patterning and the non-patterning groups, and start with the difference in industry distribution for the 2 groups. So in this figure, the bar indicates the proportion of firms in each industry that discuss green innovation in their earnings calls. And we split it into 2 parts, depends on whether they have green patterns or not. So the industry of construction and transportation stands out for green adoption, as most of their companies that discuss green innovation in the earnings calls do not have any green patent. This is because they heavily rely on external technologies like smart building systems and electric vehicles. In contrast, automobiles and electrical equipment lead in green invention. More than 2/3 of their companies discuss green innovation have at least 1 green patent. So companies choose to invent or adopt a green technology depends on their operations, but both are critical component of green innovation. We apply all of our empirical analysis on these 2 groups first is the Fama-McBurn's cross-section regressions. And column 4 and 6 show that stock market also price green innovation activities beyond the patent, and we also observe negative and significant coefficient for them, even with a larger magnitude. For the green patent groups, after control for the green patent share, the green innovation texture measure remains to be significant. Then we ask whether green adoption can help firms improve their environment performance. And the answer is yes, as we can see from the last 4 columns. Finally, we conduct the event study for the 4 events on the 2 groups respectively. As we can see from column 4 to 6, green innovation beyond the patent are also perceived as a hedge against the transition risk, as they underperform after events that imply less stringent climate regulation and outperform after events imply more stringent climate regulation. Another observation is that the coefficient for green patent share become much less significant after we also consider the green innovation measure. This may suggest that our texture measure are more accurately capturing the commercial relevance and the market perceptions of the related climate innovation. To conclude, in this paper, we construct firm-level green innovation measures using texture analysis from green patent abstract and earnings call transcript. A high minus a non-short portfolio based on this measure generate an average return of about 5% per year. These green innovative firms improve their environmental performance in the future and also better hedge against the transition risk after the enforcement of more stringent climate regulation. More importantly, all these empirical implications hold for green non-patented firms, suggesting that both invention and adoption are critical components of green innovation in terms of their financial implication and environmental impact. So I will stop here, and any questions and comments are very welcome and greatly appreciated.
Thank you very much. Thank you very much for this very nice presentation. I can already take 2 questions from the audience. First one, so I'm reading the questions. Did you include in your Fama-McBurn's regressions common predictors like book to market, return ROE, investment growth, momentum, etc.?
Yes, thank you very much for the question. So for the first one, in the Fama-McBurn's cross-section regressions, we consider the common firm characteristics that can predict stock returns in the literature, like the market size, the book-to-market ratio, the profitability, investment growth, and like the comments suggested. And also for the asset pricing factor test, we also consider related common risk factors. And for the second question, is the green innovation measure normalized in Fama-McBurn's regressions? Yes, for our Fama-McBurn's cross-sectional regression, we standardize our green innovation measure to have a 0 zone mean and 1 standard deviation for easier interpretation.
Okay, other questions?
Yeah, I can ask a few. Yes. So thanks a lot. Very interesting talk. I really enjoyed it. So I have a few questions. The first is what I find very interesting is that attention to innovation is key in your results. And then that drives me to some thought also about greenwashing, because it might be very tempting, given investors' attention to innovation recently, to talk a lot about innovation without doing anything. So I guess you have a way to decipher what firms that are always talking and never patenting, and those that are talking and patenting, to be able to separate the greenwashing firms from the non-greenwashing firms. So I was wondering, did you try that? Is there any different results depending on a measure of greenwashing? And then I have a second question about the environmental performance impact that you find. That's a very nice result, but I'm a bit surprised by it as well. In particular, because I would not expect to find an impact of green innovation necessarily on the firm's environmental performance for all sectors. I can understand that, for example, for the energy sector. So if you improve your, energy processing activity or motors types of processes, you might have an impact on your own environmental performance. But there are many other sectors where innovating will impact other sectors. And in particular, you have patents on adaptation, for example. So if you innovate on adaptation, it might have a marginal impact on other sectors, but not necessarily on your own activity. So I'm wondering if you tried also to disentangle various types of patents and sectors to see where the effect comes from. And maybe a last quick question about, because you said you used both ClimateBERT and GPT-3. So if you have any feedback on the differences between the two models and maybe interesting suggestions in the use of these two large language models, that could be also interesting. Thanks a lot.
Yeah, sure. Thank you very much for all these comments, which are great. And so may I start with the second one for the environment performance for these green innovation discussions? Yes, I believe there are different impact for different types of green technologies and across different sectors. To be honest, we do not do more or do much in that perspective. Maybe because we focus more on the green return effect in the technology setting. But I think it's quite interesting, and we can have a look at which sector have or which types of like green technologies have whether it is just to reduce their own carbon emissions or helps to reduce their suppliers or customers. Because there is also a paper in the literature that shows that firms' own green patent may not lead to their carbon reduction, but lead to the reduction of their customers. So that's really interesting to have a look, but we do not do too much on that part. We can have a look at more details after that. And for the first question, if I understand correctly, do you mean whether we construct a measure to capture whether the firm do greenwashing or not?
Yeah, at least that could be an interesting expansion, because you know how firms talk and you know what they do in terms of patents. So I'm not saying that a firm not patent, I think we should be careful, because a firm not patenting might still innovate, so we cannot necessarily say it's greenwashing. But I'm wondering if you had some thoughts about that, because it could be very interesting to have measures of greenwashing in the innovation space.
Yeah, I think, yeah. So at first I have to admit that there are absolutely merit error in our measures in terms of greenwashing. As we just discussed, due to the voluntary disclosure nature of earnings conference calls, these managers, they maybe just do green window addressing. They say that they do that, but we do not know they really or not do that. So that is an inherent issue in our measures. We made some attempts to address these concerns, but I have to admit just partially, like to show these firms without green patent, but with discussion also improve their performance and also have better quality green patents in the future. But that is limited, to be honest. On the other hand, it is possible to construct a greenwashing measure like in a separate project. To be honest, we tried some, and maybe not only for textual analysis. Like if we know a company's carbon emission target, and we also know their actual emission process, we can check whether they are on track or not of their emission target. And then we can construct measures in the also earnings conference calls. If they claim that they have a lot of technology investment to reduce their carbon emissions, then if they have such kind of technology involvement claims, but they are not on track of their emission target, then such kind of can help us to detect the potential greenwashing. But so the basic idea is to find the inconsistency of their own disclosure and their true behaviors. So that could be very interesting for another project, but we do not do too much on that in current project. And finally, for the difference between GPT and the climate bird model. So based on my understanding, GPT is better for generate sentences. So we can think it as a human. We can ask it to help us to generate some sentences or to assess whether some sentences belong to several classifications, or we can use their embeddings, which consider a lot of contextual information. So it is more like output-based, generated-based. On the other hand, for the climate bird model, I think it fits better if we have a framework that we know what is a task. Like we just want to detect whether it is climate related or not, whether it is innovation related or not. Then we must give them some training sentences with positive and negative sample to fine tune the model and do the similar classification task. So for me, I think if I have a very clear mind of what the task is, and also considering the computer hour, and also if we use GPT-4, it also more costly. In that case, I will use climate bird because sometimes it will not have lower performance compared to GPT if it have high quality training sentences. But if we have some but if we have some more creative tasks, then GPT will be more helpful, like to ask it to summarize the sentence and to even label the sentence. I also use that for some other projects. Yeah.
Okay, thank you very much. There was a last question, but it was related to what you just mentioned, actually, about the use of LLM and climate bird and GPT. So I think you partly answered that question.
Yes.
There is a question by Elise.
Do we have time for a last question?
Yep, go ahead.
Okay, thank you. Thanks for the nice presentation. I have a question actually on the fine-tuning of climate bird. So you mentioned that you're fine-tuning it on patents, but you also mentioned that patents basically are very long to be published. So I'm wondering about the timing. Are you fine-tuning climate bird on all the patents that are available in your time series? Given that the patents tend to be probably the informative patents tend to be after the earnings call, which mentioned the same technology, or are you fine-tuning, on the patents that are before basically all the earning calls and having some sort of ruling algorithm?
So we just randomly choose 1,000 patent abstract from each year during our sample period from 2008 and 2021. So for each year, we randomly choose the green patent abstract and then summarize the
sample exercise basically where you have all the patents until now, and then you look at all the earning calls until now too.
Yes.
Okay.
So
okay, thanks. And
I guess you maybe mentioned some look ahead bias.
Yes, that's exactly where I was heading. And for GPT, is there any fine tuning or how do you? I don't know. Do you do something equivalent or?
We do not fine-tune GPT. While I know it is possible to fine-tune some other large language model like normal, but for GPT, it's not very easy to fine-tune. And we also think in our task, we just ask it to summarize it to a single sentence. So maybe not necessary for this task to fine-tune
You're not using
GPT.
GPT for the classification, or you're just using climate bird for that?
We only use climate bird for the classification. So the GPT is only to help us to generate the training sentences.
Okay, yeah, then there's no need for that. Okay, thank you.
Thank you very much for the comments.
Okay, thank you very much, Tingyu. Very nice presentation. Thanks for answering the questions. I guess we'll move to the second presentation by Dacheng from Chicago, University of Chicago.
All right, can you hear me?
Yes.
Okay, wow, thank you so much for inviting me to present this paper. So this is joint work with my student Yifei Chen in Chicago and my longtime colleague and co-author Brent Kelly. All right, so here's the motivation of writing this paper, right? So we have seen that economic text is often generated by human writers like us, or reporters, who are trying to understand and make predictions about this economic phenomenon. And we believe that information, such narrative information, could be a complementary information source, valuable for investors, and we'd like to investigate that. And we also believe that the news is not just about information, recent information. So there's also kind of hidden narratives, which might drive market movement. All right, so with textual analysis, we are able to explore such hidden narratives, and we can study how these hidden narratives influence market dynamics. Now, of course, the null hypothesis is that market can efficiently process information, and we should see an immediate response whenever there's a news release about something. On the other hand, we do expect that news or market efficiency does not literally operate at lightning speed, right? So there has to be some kind of efficient delay, and this delay might vary across individual assets, and it may have different velocity and different magnitude across different assets, and that's something that we'd like to study with the text analysis. All right, so the previous speaker has discussed a lot about large language models. I don't want to repeat most of the stuff, but I do like to mention that we believe large language models provide us a unique chance to really kind of make an unprecedented scale of knowledge available for finance research. So in the past, we only process textual data within a smaller scope, but now we can actually inherit, right? So human knowledge accumulated over thousands of years, remembered by large language models, and then use that to really better understand languages and textual information. Now, this is a list of large language models, started from BERT and Roberta, and then all the way to ChatGPT, Llama, Llama 2, and Llama 3. So the highlighted models are open sourced that we exploit in our paper. So I'd like to see the economic benefits of using a more advanced model compared to an earlier version of the model. Now, the current version of the paper still uses Llama 1, but Llama 1 has been duplicated by Llama 3. So we're kind of working on expanding our analysis to more advanced Llama models. We're also using ChatGPT, but the way we use ChatGPT is perhaps very nerdy, very different from most of us, most people. So we are not going to do prompt engineering. We're going to ask ChatGPT for the embeddings, which I'm going to make it more clear later. And those embeddings are much cheaper, to be honest, compared to prompting ChatGPT and ask for a sentiment of the news. All right, so we're going to look at a sequence of models that are highlighted. All right, so let me briefly summarize what you're going to see towards the end of the paper. So we're going to essentially just leverage all kinds of large language models to create certain representations of the news text. The advantage of this approach is that our results are easily replicable. Okay, so there's no randomness out of this procedure, as I'm going to explain. And then we're going to use these representations, right, so to kind of relate them to the cross section of expected returns. So at the current stage, we're going to show you results that that try to explain the cross section of short-term expected returns, short-term return dynamics. But in a couple of weeks, we'll have more results and trying to show that how returns, how information we learn from text can be beneficial for long-term investment as well. Now, at short term, we can clearly identify the process of information assimilation. We can show that such a process takes a few more days to fully incorporate into prices. So information takes a few days. And we can also document a short-term momentum effect, right? So as we know that in a cross-section, it is well documented that at the short horizon we see a reversal effect. But we actually document in this paper that if you look at the news actually induces a momentum effect. And we also show that speed matters more than precision. So this might undermine the need for large language models. So if your computing power can only support bag of words and the traditional approach, you lose something, but perhaps not that much if you can react quickly. Now we importantly will provide some important benchmarks to show that how large language models outperform word-based approaches such as bag of word, word to vec. And we show that the reason we see some better performance from large language models is that the context matters, and large language models can effectively take into account context. And in particular, in scenarios where you see negation or some kind of intricate context, large language models can outperform the word-based approach. All right, so let me directly present some kind of methodological framework of our paper. So it's actually quite simple. So we're going to look at two different exercises. One is classification exercises. In this literature, people call this sentiment analysis, but it's literally just trying to identify the tone of the news, not the investor sentiment, just to be clear. So XIT is some sort of representation for news I at time t, and each news in our data set is associated with one and only one company. Okay, so you can think of XIT as some kind of representation for a company, for the company's characteristics, and the YIT is the tone, right? So the tone of the news at time t for stock I. And we like to have a simple logistic regression setting to predict the tone of the news. Now, XIT is certainly something I'm going to spend a lot of time on in the next few slides. So let me first talk about YIT, right? So YIT is the tone of the news. And obviously, one way of getting that is to hire a bunch of experts reading the news and figure out the tone. That's more expensive and also perhaps less objective. So instead, we're going to use the sign of the 3-day cumulative returns surrounding the news event to kind of denote YIT. Now, this measure is more objective, right? The issue, though, is that it's quite noisy. All right, so whether it works or not really depends on the empirical results, which we're going to show you. All right, so now for the second exercise is we look at return prediction directly. All right, so we are kind of using XIT as our signals. We directly predict the cross-section of returns next period, RIT plus 1. Okay, so now obviously I wish we can just run these simple exercises to highlight the value of XIT. Now, fortunately, XIT is high dimensional, so you need some kind of machine learning. So here we adopt the simplest possible ridge regression approach to deal with the curse of dimensionality, and we also experimented with neural nets, random forest, and etc. Towards the end of my talk, I'll show you some results. All right, so I hope the only thing that is unclear from this slide is XIT, which I'm about to talk about. Okay, so the process of generating XIT from news text is what financial engineering is called feature engineering, right? So there are a bunch of approaches. The simplest one is bag of words. We can simply use XIT to represent the word frequencies. It's going to be a very long vector, depending on how many words in your dictionary. So typically like 30,000, things like that. 30,000 words in the English dictionary. And we're gonna use the frequency of each word. Now we have earlier work, which were presented, I think, in another Amundi seminar before. We propose an approach to make use of this bag of words vector to predict returns. It's called a system, and we're gonna compare the new approach with the old one, and we're also gonna benchmark our results with Log-Green McDonald dictionary. So if you're just using their dictionary and create a sentiment score by simply counting how many positive words and how many negative words and take the differences, and you can also get a sentiment score. So you can compare that with ours as well. All right, a slightly more advanced approach is word embeddings. All right, so the fundamental hypothesis behind word embeddings is that a word is characterized by the component it keeps. This is a so-called distributional semantic hypothesis, right? So essentially, it translates a linguistic problem, which is to understand the meaning of a word, to a statistical problem, which is to figure out which words are likely to co-occur. So we take advantage of this model and create word vectors for each word, and then we can aggregate word vectors in each news article to create article level embedding, because the minimal unit of our analysis is an article, not a word. All right, so I'm going to create these article embeddings, and this serves as XIT out of word embedding approach. So ultimately, embedding looks like this, right? So you have a piece of article on the left-hand side, and you have two sentences, and the first word is fourth, right? So a word embedding is essentially to represent the word fourth in a vector space shown on the top right corner. And we can do the same thing for sentence embeddings. We can do the same thing for article embeddings to represent an article in a vector space. Now, of course, you can always do that. The question is whether they represent they capture the linguistic meaning of the text. So it's easily shown that word embeddings can capture the linguistic meaning, right? So as shown by this equation on the bottom, so the word vectors, they satisfy that queen minus women plus men is equal to king. So that indicates that this approach works really well for word embeddings. Now, for sentence embeddings and article embeddings, I guess we have to wait until our empirical analysis to convince you that this is actually a very good idea. All right, so now let's talk about how we get embeddings for large language models, right? So what large language models do is essentially to translate a sequence of tokens. The minimum unit is a token. So let's ignore the differences between the token and the word. It's just going to transform a sequence of words into embeddings for each word through a deep learning model. All right, I guess this is not most of us, this is not how most of us engage with large language models. All right, so let me show you kind of an illustration of how large language models work. So towards the left, you see a piece of article, the one that I showed you before. So now it's essentially a sequence of tokens, right? A sequence of words, so false, quarter, etc., etc. So after lots of algebras, okay, and through the pre-training process, in the last hidden layer, we see a representation, a vector representation for each token in this article. Okay, so this is something that you can get from, you can calculate it by inputting your article into a pre-trained large language model. You will get at the last hidden layer of the model, you will be able to obtain the word vectors or token vectors for each token. Now, how we engage with ChatGPT is to prompt it, right? To predict the next word and eventually to generate a sentence iteratively. So those next words are actually generated out of these last hidden layer vectors. All right, so from the last hidden layer vectors, through some kind of linear and softmax layers, these large language models can produce the probability of the next word. And then the chatbot on top of large language models will draw from this word list according to these probabilities. And this is where the randomness comes from. All right, so we avoid randomness right away because we only use the sufficient statistics of an article representation, right? So which is given by the last hidden layer. So we are not really playing with the probabilities here. All right, so we take these hidden layer embeddings and to represent each token, and then we average these embeddings to represent an article, like what we did for word vectors. All right, so then we're going to use this xit to make predictions for returns or sentiment. Now the benefit is that you can combine your signals. Your signals now are tabulated data. Combine your signals in whatever way with your existing signals from fundamental, from technical, et cetera, et cetera. So you're not restricted yourself from having to interact with ChatGPT, and you don't have to worry about randomness. All your results are deterministic. Now, of course, the downside is you have to have the model, right? So ChatGPT, unfortunately, is not open source. You cannot have the model. But recently, they allow you to download the embeddings. Okay, so we could actually get the embeddings, which is much cheaper. And that's what we get. Okay, so we fit in ChatGPT an article, and we can get these embeddings, this last hidden layer information out of a ChatGPT model. So now we can put ChatGPT under the same ground with other models that are open source models, and we're going to compare the value of ChatGPT model with other large language models, and further with bag of words and word2vec. All right, so here's our data set. Okay, so we look at international news. We gather these news articles from Refinitiv. And Refinitiv is a very good data source for international news. And these news are from, I remember, 16 countries in the regions, and written in 13 different languages. All right, so a large language model can directly process different languages, so we don't have to do any translation, so which is very convenient. Now, in the end, after some cleaning, in particular, we have to remove articles that are tagged with more than one company or have no tags. That reduces the total number of news we have for US, like 3 million. All right. Now, for US, there are two types of news, actually. One is raw articles. So it's like a regular news article. It has title, it has a body. And there's another type of article, which is called alerts. So alerts are much shorter. So you can imagine reporters have not got time to finish up an article. So we only get a title, right? We're gonna get a title. And with alerts, we also know that some alerts are the first wave of alerts, and some alerts are the second wave of alerts. And we also have a third and fourth waves of alert. So we have a label called take sequence, and that tells us whether this alert is first wave or second wave. And that's also very useful to help us investigate information assimilation process. All right. So of course, I can show you some statistics like root mean square errors, prediction accuracy, and things like that. But I choose not to do that. Instead, I'm going to provide you with the numbers that we can consume from economic point of view. All right, so we're gonna interpret everything using portfolio returns and Sharpe ratios. So we're gonna translate all these predictions into portfolio. Okay, so we build a long short zero investment portfolio at 9:30 a.m. every day, and we long short and we rebalance on a daily basis. Now this would not be how Amundi and other investment firms build their investment strategies, I guess, right? So because there's certainly transaction costs, there's certainly liquidity, there's certainly risk issues, and you won't be trading at 9:30, but you probably start trading maybe at 10 or slightly later. So now, here we want to emphasize, the benefits of expected returns. So we just look at long short portfolios, not taking into account anything else. So whatever Sharpe ratios and investment returns that I'm going to show you, you have to take it with a grain of thought to think that, maybe if you have a very good risk model, you can manage the transaction cost well. So you should be able to benefit from such a trading strategy. But the comparison across different models, which is the main focus of the paper, definitely stays. All right, so let me start right away with this performance of sentiment portfolios, right? So with this approach, we can make predictions about returns at 9:30 for the next day, and we're gonna long the top, short the bottom, and build a long-short trading strategy. We are showing you equal weight, value weight, and for different models. So let's just look at this number, right? So ChatGPT, equal weight portfolio give me a 4.62 Sharpe ratio, annualized. Now value weight is of course much lower, 1.4. This is a well-known size effect. Now Llama 2 give us 4.16, Llama 3.89, Roberta 3.75, BERT 3.6. So you can see a nice decay, right? So if your model becomes less sophisticated, the Sharpe ratios are lower. Now word to vec give you 3.0. And our old approach based on bag of words give you 3.4. So not so bad, right? Not so bad. Of course, you can do better to get 4.6 if you invest in large language models. Now, Logren McDonald give you 2.29. All right, giving 2.29. So now, as you can imagine, I can tell you, roughly speaking, the transaction cost is like greater than a Sharpe ratio 2.29. So you won't get any excess return out of Logren McDonald approach. All right, so that was based on sentiment scores, right? So we can also do so with predictions, right? So using ChatGPT, you get 4.23. So here we're kind of predicting the entire cross-section of stocks and long short portfolios. You get 4.23. So it's a bit disappointing, right? So, but Llama actually does pretty well. So 5.31, and Llama 1 is a 5.17. So it's even higher than sentiment analysis out of these large language models, except for ChatGPT. I mean, we don't know how their embeddings were generated. But definitely for these other large language models, we downloaded their entire model, so we know how their embeddings are created. So indeed, we find stronger returns with portfolio prediction directly. All right. So this slide, we're comparing predictions based on article versus predictions based on alerts, right? So if we're using predictions based on alerts, right, looking at their sentiment analysis using alerts, you can see that trading alerts give you a higher Sharpe ratio than trading articles, right? Now, if I just trade the first sequence of alerts, you're going to get a higher Sharpe ratio than trade the second sequence of alerts, which is going to be a higher Sharpe ratio than third and fourth wave of alerts. So you can see clearly there is decay, right? So, as time goes by, the Sharpe ratio you can get is getting lower. Now, of course, I would wish to have, even if a simpler model like system to trade earlier, like you can get a 4.41 Sharpe ratio, rather than having a large language model that trades slower, right? So gets a less Sharpe ratio. So clearly speed matters more than precision. All right.
Can I ask a clarifying question? Articles can also be published in a sequence, like a journal publishes an article first, and then another journal might write about the same story, but one day later. Do you consider all articles?
We don't have the label. Yeah,
okay.
We consider all articles because we don't have the label.
Okay.
We don't. There's not a tick sequence, right?
Okay.
Like label, tell me this is first wave or second wave. Yeah. All right, thank you. So, so here I'm kind of showing you how essentially how average returns that you can get per day. All right, so so the previous slides is about day one Sharpe ratios, day one returns you can get. So left hand side is the y-axis is average returns per day in basis points. And if I don't do anything on day one and just trade on day two, I get a much lower kind of basis points based on news articles. And on day three, you don't get almost nothing, right? You get almost nothing. Now across different models. All right, so but for news alerts, you can see on day one, you get a much higher average basis point per day, and day two, you can get much lower, but day three, you can still get something, but not a lot. So to make it more clear, right? So we look at articles versus alerts for different size companies. So you can see that on day one, you get like 30 basis points for articles for small companies, and already only like 5 or 6 basis points for large companies. Now day 2 and day 3, right? So this is for alerts. So alerts, you do get a much higher basis point per day for smaller companies. All right. So now let me document something about the momentum effect. All right. So here, if I ignore information from text, just short stocks based on their past 5-day returns, okay? And along the high return ones and short the bottom return ones, I can see a negative Sharpe ratio, right? Which means that I should not along the top returns, I should along the bottom returns. So in other words, the stock market shows a clear reversal effect, okay? Shows a clear reversal effect. Now, if I just look at stocks with news, okay? Stocks with news, because here it's the entire market. So here, if I look at stock with news, and only sort based on their returns, ignoring news, and I get a minus 1.58 Sharpe ratio. All right, so still reversal effect in the cross section. Now, suppose I combine past the 5-day return and the information from the news. All right, so and I can show you that with our approach, you can get 4.16 Sharpe ratio on day 1. 1.26 Sharpe ratio on day 2, and et cetera, et cetera. So clearly there is a momentum effect, you know, instead of a reversal effect, right? So this is not a reversal, but a momentum. So you can see news gradually incorporated into prices. Now, we also show you that if you just use returns, you know, you can get 1.58 Sharpe ratio, but you started to use words in addition to returns, like 2 signals, right? One is news, one is returns, you can get a higher Sharpe ratio than just using returns. Now, if you take into account not only just word, but also context through large language models, you can get a higher Sharpe ratio. So what context do better than perform better than words and more useful than just using returns. All right, so I'm going to use my remaining time to discuss why large language models disagree with word-based models, right? So why they disagree? First of all, let me show you an anecdotal evidence, right? So this is a piece of article about British Airways. All right, so this is a negative article. The more blue you see, the more negative the sentences are. Now, large language models like Llama 2 classify the whole paragraph overall as negative because, for instance, the last sentence, IAG was not immediately available, was recognized to be a very negative thing. Now, bag of words and word2vec, they both recognize this article as very positive because they see the word raise. Okay, raise is actually contributing positively overall. You know, that's because raise on average are more often associated with positive returns. Now, unfortunately, the subject here is concerns. Concerns have been raised. So that's why, you know, these bag of words and word2vec, they make mistake. But large language models can understand this as a negative sentence, All right, so this is why they differ. Now let's kind of take this into like more systematic analysis. So how we do it? Well, we decompose the entire body of articles into articles without negation words and articles with negation words. So this can be done easily with the Python, okay? So to figure out whether articles have negation words. All right, and within each body, all right, within each subsample, we build the same long-short portfolios. Okay, we build the same long-short portfolios as before. Now, what we find is, in particular for you know, large language models like Llama 2, Llama, Roberta, BERT, you'll find that for articles with negation words, you can see that the Sharpe ratios are actually higher than articles without negation words. Okay, without negation words, and the main benefits come from the short side. All right, for the short side, you can get even higher Sharpe ratio. The more negative, the better. All right, so then the positive side. Now, of course, this could be article fixed effects, right? So these articles may, you know, just on average more negative, but this is not the case for system and word2vec. So for system and word2vec, as you can see, they suffer from, you know, the short side for negation articles because they fail to understand the negation context, and they won't be able to, you know, really gain a much higher Sharpe ratio than large language models. So all the large language models can give you a higher average return for a higher Sharpe ratio for the short side, and as a result, you know, system and word2vec, they learn a lower Sharpe ratio for articles with negation words. Right, so if you do a diff in diff analysis, you'll be able to get rid of article fixed effect. You'll see that system could have got a higher Sharpe ratio, but they did not. And the reason is because they suffer from understanding of negation context. All right, so here's another piece of evidence where we look at article headline versus article body. All right, so it turns out, we can, if we fit in article headline only to ChatGPT large language models, you find that they can have a lower Sharpe ratio than you give only the body. All right, so in other words, large language models can benefit from the complexity in the body. All right, so in the body of the article, the details, and they can get a higher Sharpe ratio from that. But if you do it with a word-based approach like system or word-to-vec, you can see that with body, there's so many more words, and they got confused. Sometimes you have some negative words showing up, you get confused, and you get a lower Sharpe ratio than using the headline only. All right, so here, hopefully we can convince you that, large language models can really benefit from the, intricate context, the narratives, and they can actually earn a higher Sharpe ratio. This is why they can earn the higher Sharpe ratio. All right, so I guess this is my final slides, or maybe one more. So here we're trying to present you with evidence, across different languages. Turns out, the punchline though is that across different languages, we do find evidence that large language models can help. Okay, of course, to what degree, right? So that varies across different countries. Now, turns out the most important determinator, like why different countries learn different Sharpe ratio, have different Sharpe ratio gains from large language models, is how many stocks we can trade. All right, so for countries like Greece, Netherlands, and Portugal, our data set is, we don't have many news. So every day we can only trade very, very little, very few news articles. Now for US, UK, and those companies, we have we have very good news coverage, and you can get a much higher Sharpe ratio compared to these countries. So, but in the end, clearly the slope is much higher for Llama and lower for this word-based approach. All right, so essentially, large language models can still do better than word-based approach. You can still see a sharper gain with more news coverage from large language models. Now, finally, we want to show you, what happens if you use advanced machine learning methods. So instead of linear models, so you can get higher Sharpe ratios from, say, for example, neural nets. If you would like to spend such a amount of computational effort, you could actually benefit from more advanced machine learning methods than just simpler machine learning methods. All right, and this is a slide about transaction costs. There's a huge cost by turnover on a daily basis, right? So, but in the end, the net Sharpe ratio is positive based on our assumptions on transaction cost. So it's not as high as like 4 point something or 5 point something, but you can still get something out of it. All right, so let me conclude. So in this paper, we're trying to emphasize how news get into prices and how quickly it get into prices, what are the relative magnitude across different stocks. And we want to show that large language models can actually be more effective than word-based approach. And we expect that the literature on large language models will explode, and we will see lots of work, interesting work, including the one we just saw, on good use of large language models for commercial research. Thank you very much.
Thank you very much, Dacheng. Thank you very much. Very nice presentation. Very interesting. Questions from the audience?
Yes, I'm happy to start with 2 questions,
Yeah.
Dacheng. So very, very nice presentation. I enjoyed it a lot. So you didn't explore much of the differences between large language models. So I wanted to know first, are the difference in performance significant, and what can explain differences across large language models? And I have a second question. I found very interesting the analysis you do across countries. And there is a lot of debate, in particular among regulators, that large language models might put different countries into some different a disadvantage because the corpus of the body of language of text might be biased towards certain languages. So I was wondering, do the differences come only from the stock universe, or does it also come from the quality of the large language model in different languages? And I was wondering, you could probably do the simple test of restricting the US universe to a smaller universe of stocks, comparable to Greece or Portugal, and test how the large language models compare, their performance compare on the same number of stocks, because that would be also very, very interesting to know.
Okay, so thank you so much for two excellent questions. You're absolutely right that we are not able to show, we can show you that certain large language models do better, and not surprisingly, the newer ones, right, do better than older ones, right? So, you know, why they do better, I mean, this is hard to identify. You know, we only know that these models are more complicated, right? So they have more parameters. They do share architecture, right? So all these GPT models share the same architecture essentially, even though we don't know what's going on with ChatGPT for sure. So Roberta and BERT, they are a bit different, right? So they're like, you know, bidirectional large language models, so which is a bit different. So we don't know if the benefit, you know, between Llama and BERT is due to like, you know, one is GPT, the other one is BERT. So we don't know that, but we do see that later models do better. Now, in terms of your second question, which is also a very important question, like, you know, do we know the performance is due to different languages, or is that due to different stock universe? I mean, clearly stock universe matters. Now, we did actually address this in the paper in the following way, okay? So we report the accuracy of the prediction. So when we report the accuracy of the prediction, we look at it over the entire sample, right? So, you know, for each country, we have a huge sample. So we can look at how accurate our prediction is, you know, so like in terms of root mean square error, in terms of, you know, classification accuracy, positive, negative, how likely you get it right. So we do not find significant differences across different countries or different languages. You know, but when you take these predictions to investment, you know, you cannot really get a high Sharpe ratio by trading 3 stocks per day, right? So I think that's kind of why we believe the reason is not, you know, unfairness across different languages, but mainly on the news coverage that we can have. Yeah.
Okay, very interesting. Thank you.
Thank you very much.
I'm just reading one question here. Maybe you answered it in the last slide. Actually, what is the impact of trading cost, specifically when daily rebalancing?
Oh, okay. Yeah. So I think we had a comparison previously. So you do have a huge daily turnover, right? So like almost 100% turnover. Now, of course, if you change the entire stock, that's 200%. So we kind of change half of that. So it's a very high turnover. So now we assume, I think, 10 basis points for larger stocks per turnover, per 100% turnover, and 20 basis points for smaller stocks per 100% turnover. I mean, these numbers we got it from, you know, some investment company that I won't want to name, but I don't know if they apply to different places in the world. No, I'm sure some people can do much better than that. Right. So so then you do long short and you can calculate, you know, how much Sharpe ratio you can get. You know, this is the Sharpe ratio you can get. So then of course, this is still underestimate maybe how much better you can get, in the sense that we don't take into account risk, and we're doing the naive equally weighted long short, right? So if I were in the hedge fund manager, I would probably you know, using smarter weight to kind of amplify the gains you can get, and to take into account the cost and things like that. So,
and you're not
you know,
accounting for
yeah.
shorting costs, right? It's only transaction costs.
No, right. So we don't have right, exactly. But on the other hand, we don't really get much returns from the shorting side anyway. So we get a lot of so shorting side mainly provide a hedge, you know, when there is a crisis. So in the end, don't get much return from the shorting side. But you're right. We you know, if I were to have the data, or if I were to seriously take this to investment, I do have to take into account all kinds of costs. You're right.
Dacheng, I was wondering about one thing. So you talk about the speed of music simulation, which can last up to 3 days, which I find a bit surprising. It is, we think with high frequency trading, this type of information, once it's processed, should be integrated and processed very quickly. So is it due to the difficulty of interpreting this information?
So this is an excellent question. So we were puzzled at the beginning. But first of all, let me state a fact, right? So suppose you actually start trading within a few minutes, right, after the news announced, you can get an even higher Sharpe ratio, right? So that would be the kind of gains you can expect from high-frequency traders. But we also think that high-frequency traders cannot take everything away, right? So think about a very large investor, right, investment company, right? So what typically happening is that they have a huge portfolio, and even if there is a very good news within the day about Apple, they won't be able to rebalance right away because they need to think about how to size IBM, how to size other stocks. So most of the very large investors, they gather information from within the day and also overnight, and they calculate their positions overnight, and they start trading, start from the beginning. So I think, so their response, right, so will be slower than high-frequency traders, but they do respond. And as a result, returns, you can still get something out of, even a few days later. Yeah.
Okay, thank you very much. Other questions? Well, if not, I'll have to thank again Dacheng and Tingyu. Thank you very much for presenting. It was really, really interesting, fascinating topic, which I think is and it's an upcoming topic, as Marie was saying. So it's really becoming very, very popular. So thank you very much for these very interesting presentations. I just want to mention 2 things. So the next webinar will not be a webinar, but a workshop. It's a joint workshop organized by the ESSEC-Amundi chair and the ESSEC Shaping the Future of Finance chair. And it's going to be on artificial intelligence and sustainable finance. So related to what we just discussed today. It's on November 26th. That's going to be at La Défense in Paris, but it's also going to be on Zoom. So you'll receive a mail with all the information. And last point, I just want to mention, we just released a recent research letter. So that the ESSEC-Amundi chair produces research letters, which basically summarizes papers that have been published in the on specific topics. So the last research letter that was published was exploring the greenium in the equity and the bond market. So if you're interested, all the research letters are available on the ESSEC-Amundi website on the ESSEC page. So thank you very much, Tingyu and Dacheng. We really appreciate your participation. I hope everyone enjoyed, I'm sure. And we're looking forward to see you at the next workshop. Thank you very much. Bye-bye.
Thank you. Thank you very much.
Thank you. Bye-bye.
Great
Thank
seminar.
you very
Bye-bye.
much. Thank
Thank
you
you.
very much for
Bye-bye.
the invitation and organization. Yeah, thank you.
Thank
Bye.
you. Bye.